Good morning and welcome to the Haven Financial Group radio show. Thanks for listening. Feel free to give us a call this morning at 612-504-8400 or visit us online at havenfinancialgroup.com. Kim, good to be with you. And Kim, we got Kyle Thomas, our certified financial planner on the Haven investment team, also with us this morning.
Yes, and it's great to have Kyle, and it's good to be with you as well. Here we are, just the weekend before the 4th of July. That's hard to believe, isn't it?
It is.
Where's the summer going, Larry?
I know, but we know what that means. It gets the 4th of July, and then we go the other direction. And I know we don't want to ponder that, but that's kind of reality.
Please don't say that.
I know.
Well, we got a great show for everybody today. We're going to talk a little bit about bonds, tax bills, and how all of that might play into one's retirement strategy. And we're so glad that Kyle Thomas could be with us to talk a little bit more about that. As we break down the show, we're going to talk about Moody's. They have downgraded U.S. bonds. What kind of impact does that have on all of us? And especially what kind of impact does that have on pre-retirees and retirees? We'll talk about keys to conservative investing in this economy. We're going to talk about what's in Trump's new tax bill. And finally, we'll wrap up the conversation today with basics for tax strategies for retirees. So let's talk a little bit, if we could, gentlemen, about this Moody's situation that happened really back in May, but is impacting, everyone now.
Yeah, this is definitely something that is kind of eye-popping when you first hear about it. The U.S. government getting downgraded in their credit rating. Mm-hmm. All in total, what we got downgraded to is still very, very good. So right off the bat, I'm not too worried about the government in a sense of defaulting on any credit that we have outstanding, just like Treasury bonds that the everyday person owns. Mm-hmm. But what it does mean, so Moody's changed the outlook for the government debt. We have $36 trillion in debt, and we have rising interest costs. We have tax cuts potentially coming here, potentially this year. And there's a lot of political uncertainty going on as well. So this does play a role in creating some, blurry vision going forward here. The way that bonds work is when you receive a higher interest rate on your bond, you're typically taking on more risk. And with the credit rating of the United States dropping, in theory, the rates should increase because you are taking on a lower quality bond than you were previously earlier this year. So everyone is expecting rates to come down. Everyone wants rates to come down because, that means inflation is kind of cooling. But with that, it kind of makes it harder for these interest rates to come down if the credit rating is lesser than it was previously. Mm-hmm. So that's one side of it that is interesting to watch because although it doesn't really impact our faith in the government and being able to pay out, it does impact the interest rates overall.
So let's talk about, gentlemen, why this is important to retirees.
It's very important because Treasury bonds can serve a really big piece of a portfolio. They serve a big piece for our portfolio specifically. There's different types of Treasury bonds. So you can have standalone Treasury bonds. You can have Treasury inflation protected securities. So the interest that you're going to be receiving definitely can impact your portfolio. And it's important to make sure that you have the right allocations within those investments because those rates will change, and you want to make sure that your exposure is not going to be over the top one way or the other, or it's going to be underweight on the other side. Mm-hmm. So it's important because also there's a lot of income that can come from those investments. A lot of people depend on the income from those treasuries, that interest that they pay, to live on, month to month or however that case may be.
We talked about it right off the top. I mean, again, Moody's downgrading U.S. bonds, but it was a slight downgrade. And boy, that makes big splashy headlines, and the media likes to talk about it, and it's great across the business pages. But, you got to look beyond this, because you've even said that this is not like the government's going to default, and Moody's has not stated that by any stretch of the imagination. So, Kyle or Larry, how do you plan beyond this?
Yeah, let's first and foremost say, the downgrade. Yeah, it was a downgrade, and just that word alone has a is negative. AAA rating though to AA1, it's not a huge thing. Okay, you're right. It makes headlines. It puts fear in people. It sells the news. One thing that isn't talked about much. Kyle mentioned we got $36.2 trillion in debt. That is alarming. And I know nobody wants to talk about it, really. They talk about it, but it's really just talk. I mean, if you really want to depress yourself, go to usdebtclock.org and see how it's ramping up so fast that sooner or later we're going to have a heart-to-heart discussion in government of how we reduce the debt. Now, there's a variety of ways that they're talking about doing it, but it never seems to work. And that number just keeps on going up. For the listeners and the retirees, those that are getting close to retirement, this creates a really good time to reevaluate your portfolio. Slice it and get it reviewed, and making sure that you're in the right place at the right time. And it really shouldn't take headlines like this to make you do it. But if it does, well, maybe that's a positive thing, because at Haven, we're looking at this on an ongoing basis. This isn't something that, we're looking at 1 year and then we're just going to let it sit on the sidelines for the next 2-3 years. No, this is something that you should be leaning on a partner with to explain these things, to help you understand these things, to make sure that based on where you're at as far as the timeline for retirement, that you're in the right position, that you have the right duration bonds. How do bonds play a part of your portfolio? Some people don't like bonds, so they're heavier in stocks. The important part is to have these conversations, and that's what I find people are not having these conversations, and that's where the fear comes from.
Absolutely. If you do have bonds in your portfolio, this is not a panic situation for you, though, correct?
No, this is not a panic situation by any means, in my opinion. The government has the unlimited taxing authority to back these bonds. So although if push comes to shove, they can raise the taxes and pay the debts that are owed on these bonds. And that would happen, but that's never really happened just to, pay these debts like that before. It's just always kind of been a steady increase over time. So they will pay out. We aren't worried about that. But yeah, again, that interest rate can definitely play a role. And having more short duration bonds in your portfolio can really help mitigate some of the risks of this, because those short duration bonds are much less sensitive to these interest rate changes than intermediate or long-term bonds. And intermediate and long-term bonds have been more traditional holdings in portfolios. And we actually changed our allocation a little over a year ago to have more short-term bonds, because we saw that the interest rates were not going to be coming down as fast as everyone anticipated. So that was a proactive move that we made within our portfolios, and it has paid off for the last year here.
So, Kim, at the end of the day, Kim, a credit downgrade doesn't change the fundamentals of retirement planning. It simply adds a new layer of complexity, if you will. That's why working again with a financial partner, a financial advisor who keeps an eye on the big picture, while tailoring strategies for your situation, and it's not the same for everybody, can be very, very valuable. And if you're not getting that, or if you want to make sure your portfolio is built to weather this uncertainty, which is always going to be here to some degree, please give us a call today. Let's have more conversation. You absolutely have nothing to lose and only things to gain from having that conversation.
Absolutely. And the number is 612-504-8400. Give them a call at Haven Financial Group. Who knows? This downgrade could maybe be an opportunity for someone versus something that's negative. So again, that number is 612-504-8400. Gentlemen, when we come back, we want to talk about keys to conservative investing in this environment. These are some uncertain times, that is for certain, and a lot of people maybe are looking for some more conservative ways to invest their money while they ride out what appears to be, to some, a bit of a storm. Certainly rough waters, we'll put it that way. So we'll talk about that when we come back right here on the Haven Financial Group radio show.